Hey everyone, in this video we're going to talk about trading zero DTE options in a low volatility range bound market. Now this could be a challenging environment to find profitable opportunities due to the lack of volatility in the underlying asset. Therefore, when trading in this environment, it generally requires a different approach and different strategies than say a high volatility market. First, it's important to identify the trading range. What is the key support, also known as the lower bound? What is the resistance, also known as the upper bound? And what is the pivot point, which is also a key level? Now, the pivot point is generally viewed as fair value, and it is simply just the mean between the support and the resistance levels. Now, it's important to identify these because these levels are where we're going to be structuring our trades, where we're going to be looking for entries and exit opportunities. We're looking at the S&P 500 here, and we can see the market has been contained to a range of 4150 on the upside and 4100 on the downside, with 4125 as a pivot. Now, of course, analyzing price action, we can clearly see the market is range bound. However, just by analyzing price action, it may take us a while to actually determine the trading range. So what we like to do at zero DTE traders is to identify key levels by looking at total gamma. So we can see the gamma at these strikes. And what we're looking at here is just the total absolute gamma. So this is call gamma plus put gamma. And this is beautiful as it allows us to objectively quantify the strength of support and resistance levels. Now we can see that 4150 is huge in terms of gamma. 4100 also huge in terms of gamma. So the market is contained to these large gamma strikes with 4120 as the pivot here. So we can see this reflected in the price action, but the reason why the market is contained here is due to the options positioning in the market, or at least it's having a major impact on keeping price contained to this trading range. Generally, the best strategies to deploy are short volatility strategies. So this includes the credit spread, which is a very popular zero DTE option strategy. The iron condor, which is also quite popular, is simply just a credit spread, but you're selling the call and the put at the exact same time. The iron butterfly is another short vol strategy, very similar to the iron condor. However, it involves selling the at the money call and put spread simultaneously. This can also be skewed to express a directional bias. And we really want to be anchoring these short vol trades off the upper and lower bound. So we would look to go short the market when the price is at or near the upper bound, right? This involves selling a call credit spread above the upper bound of 4150 in this case, and looking for take profits at the pivot point, the 4125. You're always looking for reversion to mean, and then sometimes you get that continuation back to the lower bound, which of course would also be a target point. Now that short call trade will remain valid as long as, in this case, SPX holds below 4150. Now by the time you get to the lower bound, you want to be looking at upside opportunities. And you could sell puts below the lower bound of 4100 in this case, and again play that reversion to the mean, looking for a 4125 take profit. Now you can go ahead at the open, particularly if you open at that middle bound, right? You open at the pivot point, which we deem as fair value. So when it comes to trade entries, I never recommend entering a trade at the pivot point. There's just really not any directional edge there. And I think it's very difficult to manage risk if you're trying to be directional. However, if you open at the pivot, implementing a market neutral strategy such as the iron condor or an iron butterfly generally is a very good idea, and it allows you to position outside the upper bound and the lower bound by selling a call credit spread and a put credit spread at the same time, and not having that directional exposure. Now you can trade the iron butterfly and actually skew it directionally, right? Using the same entry points, such as if you're at the upper bound, you can skew it downwards. Conversely, if you're at the lower bound, you skew it upwards, get a little bit of a directional exposure. And of course, those iron flies can work exceptionally well in this type of environment. Lastly, the long butterfly spread. Now, this is a favorite among a lot of our traders for good reason. It's low risk, high reward. But the fact is, it is a long volatility strategy that does benefit from an increase in volatility. Therefore, if you have an absence of volatility, there's definitely some challenges with deploying this strategy. In addition, determining where the market may pin in a range-bound environment can pose a challenge as well, because simply there's just no clear directional conviction. However, more often than not, the market pins somewhere around the pivot point because that is deemed as fair value. So if you do opt to trade the butterfly spreads in this environment, I definitely recommend still structuring the trades off the upper bound to go short, the lower bound to go long. Now, I think it's important to note that this is not an ideal environment for day traders. We want volatility because volatility brings opportunity. So when there is a lack of, perhaps it's best just to tame things back a little bit and then wait until volatility picks up again, which would be a break essentially outside the trading range, right? Break out or break down. And then at that point, we can start to deploy some long volatility strategies and get a little bit more aggressive. But as long as we stay range bound, short volatility strategies generally perform the best.